All right, thank you, Mr. Chairman. Ms. Murphy, your business model is built upon trying to get to yes for your customers. People apply online, they come into your bank. You would like to help them within, of course, the rules, get to yes. What are some of the major reasons people are unsuccessful qualifying for this loan? Is it credit score? Is it they don't have a financial statement? Or they just kind of just drop out because they're overcome with the process?
That's a great question. So we generally don't have people dropping out because they're overwhelmed with the process. We do focus as a government guaranteed lender. We do have dedicated resources for the borrower on our team. Where we find the turndowns is usually, the lack of repayment ability. It comes back to the core of what we have to do in SBA is the borrower has to be able to repay the loan. So when they send in their financials and the projections and they can't repay the loan on their projections or historically, then unfortunately we have to tell them right now, no, we need you to be able to repay this loan. When a borrower can't repay and then there's a default, effectively they now have a debt collector of the U.S. government until that is paid in full. When we look at these two proposed rules, the affiliation rule, removing the guardrails around underwriting, around the repayment, the basic premise of well-established of how we underwrite, there's a fear that that is where we would have increased program costs because of increased defaults, which hurts the borrower.
Eventually it would. One of the big advantages of a community bank or a credit union is really knowing your customer and being able to, a reputation is still worth something, and you get this, are they hardworking, some of those things. And as you figure out their ability to repay that loan, there's objective measurements. But if you're a fintech program, do you think that they'll be able to assess the ability to repay the loan in the same fashion you will?
I think it comes back to, again, the well-established rules that are already set that the SBA is proposing to remove. With those guardrails down, we just don't know on how these borrowers are going to perform. We don't know what their repayment ability is going to be. And the reality is, as a federally regulated lender, as a bank, we will still be doing those things. Our regulators expect us to do those things. So all of a sudden, our borrowers don't have an equal playing field depending on what lender they're talking to. The rules would be different because the rules are not set by SBA anymore.
Mr. Schwellenbach, as you look at these rules for fintech, do you feel like that they're being held at the same level as community banks and credit unions are?
I'm not sure exactly how to answer that question, but I will echo my fellow witness that the rules of the program are absolutely critical. If you look at some of the internal correspondence by some of these fintech executives talking about these high rates of fraud that they were internally seeing during the Paycheck Protection Program, a lot of them were very dismissive of these high rates of fraud because they said, look, this is on the SBA, the rules are lax, it's on the government. So if you have lax or non-existent rules, how can you expect companies that are participating to stop this? So
an SBA loan, just by definition, is going to be more risky than a PPP loan for a business that's been open for 5 or 10 years. What would we need to add to beef up the rules that we've seen to try to bring fintech to a level playing surface and to try to make sure we don't have more fraud? What needs to be added?
So I want to start off by saying that there's some really unusual things about the Paycheck Protection Program, and that may be the understatement of the day. Yeah. But
that's really not my
obviously
question.
It was a huge program. In many ways, it was more of a grant program, since such a high percentage of loans were just forgiven. So at the front end, there was sort of this expectation.
I'm sorry, my question is about the PPP rules. I'm saying going forward, what needs to be added to give us some less rate of fraud and less rate of failure?
Oh, in the PPP rules or the 7A? The 7A.
The new 7A rules for fintech.
So I think you want to keep a lot of the rules in the 7A program and not weaken them. You don't want to take them too much in the direction of what you had with PPP. You want to know if the borrower can repay. You want to make sure that the lender who's processing the loan actually verifies that the company seeking a loan actually exists and is an active business and isn't someone who's just going to buy a Rolls Royce with the money and flee to another country. So these lenders or potential lenders, SBA needs to make sure that they have their ducks in the row, that they have their systems in place to know their customers.
Okay, I yield back. Thank you.
And just one more thing, even pre-pandemic, the SBA's Inspector General has found that the SBA's Office of Credit Risk Management was not conducting enough oversight over participating lenders, and this is all pre-PPP.
Well, there's a history about the SBA regulating